So, dear students, a very warm welcome to all of you out there. Greetings of the day. I hope and I pray that every one of you is doing great. Well, I welcome you all in today's day two of AAA live exam focused revision. And in yesterday's session, we discussed quite a lot of things, including regulatory environment, ethical and professional considerations, quality and performance management. And And today we are going to kickstart our proceedings from learning objective, which is a very important one. That is planning and conduct of the audit of historical financial information. Very, very important learning objective. Walaikum assalam, Sharia. I hope you're doing good. Okay. So a very important learning objective in which there is the discussion about the planning phase of the audit, actual testing, actual conduct of the audit, evidence gathering, testing, and then completion and finalization. Okay. So we know, although we know what planning is, I'll not discuss very basic concepts because you already know these things. Okay. The very important thing, number one, phases of the audit. The most important phase, the first phase, the audit is divided into three broad phases. Number one, planning of the audit, planning of the audit. And in the planning phase, we carry out risk assessment, risk assessment. I always say this, that for any task to be accomplished properly, even for your preparation, even for your exam execution, utmost thing, the foremost thing which is required is the proper planning. Okay, so since planning has its very vital role play in every phase of every task, therefore, such a big exercise, audit exercise, planning holds a lot of importance. And it is rightly said that failing to plan is basically planning to fail. So if we fail to plan the audit properly, so that means we are planning to fail in an audit engagement. Same goes good for your preparation and for your studies as well. Failing to plan is synonymous to planning to fail. Same holds good for your answer planning. If you fail to plan your answer well, that means you're planning to fail. Same thing goes good here in audit. So planning is a very important phase, and question number one revolves around the planning stage of the audit. Okay. Now, let me give you an overview, although you already know this, but obviously since this is a revision session, so let me give you an overview. When we talk about planning of an audit engagement, the primary activity, there are lots of activities, but the primary activity is we are planning that which area of the audit, which area of the financial statements is risky. When we say risky, what do we mean? We simply mean that which area of the financial statement is prone, is more susceptible, is more prone to the risk of material misstatement. That means which figure might be problematic, which figure might not be correct, might not be accurate. And obviously, being an auditor, we should be willing to channelize most of our efforts to those figures which are giving a feel of being problematic, which are not looking very accurate. Or in other words, I say that where we smell the problem. So we will always try to channelize more efforts to those areas where we feel, where we have a feel, where we have an intuition that this area might be problematic. How do we have a feeling that this area of the financial statements, fixed assets of the financial statements, revenues in the financial statements, or for say non-current liabilities in the financial statements, they are under the risk of misstatement. When are we going to say it? And how are we going to reach at this conclusion that this might have the problem? So during the planning phase, we carry out risk assessment procedures. We have such procedures which give us uh, some indication that this area in the financial statement may be problematic, or is problematic. It does not actually gives you the amount which is a misstatement. No, it will simply give you a hint. It will simply give you a hint, an indication that this area might be problematic. Might be problematic. So we will perform risk assessment procedures in which primarily we perform analytical procedures. You know this. And by performing those analytical procedures, the risk assessment procedures, inquiries, we reach to a conclusion that this is a problematic area. Okay, if any area is a problematic area, then what are we supposed to do? We're supposed to have more focus and more emphasis on that area in terms of testing, in terms of gathering evidences. That's the second phase of the audit. Conduct of the audit. Are you getting this? Conduct of the audit. I hope you are. Uh, I hope you can see my screens, and I hope you can see the pointers hovering around the screen. If this is the case, can you please acknowledge me? Can you see the presentation mode? Dear students, can you see this presentation mode? Can you see the pointer hovering around the slide? Everyone, can you please confirm me? I cannot see your messages. If you're sending me any. Everyone? Okay. So these are some basic discussion. What is an assurance engagement? What is an opinion? Reasonable assurance, lower level of assurance, and things like that. This is a very basic discussion. But yes, this is what the core area is. Why is the need of the planning to target the areas with greater misstatement so that we can address those misstatement? We can design a suitable audit approach. Okay, we can allocate the risky areas to the senior guys in the audit team. We can set materiality levels. We can plan effectively, and if we plan effectively, what will that result in? That will result in a better understanding of the client. And when we have better understanding of the client, don't you think that we may be able to identify the problems in a much better way? Until and unless this is the same procedure as when a patient visits a doctor. So the doctor tries to understand the patient's history, understanding of the patient. What problem is he facing? What is he feeling? What pain is he having? Are you getting? Then the doctor tries to reach the conclusion. Then the doctor tries to diagnose the problem. So first of all, understanding is very important. So the same goes good here with the company as well. Understanding the client's business. If we have proper understanding of the client's business, then we would be able to identify the pain point, the problem, and identify the key risks so that we can target our procedures, we can target our time, we can channelize our efforts to address those risks. Are you getting this? Key planning, consideration, understanding, setting materiality levels. So these are all uh, planning activities, setting materiality levels, risk assessment, extent on how much we can rely on analytical procedures, practical planning issues, who will do which task, or a strategy, which areas to focus more, where we should be control focused, where we should be uh, doing the detailed testing. And we have a very important standard ISO 315, which says that we should, first of all, have the understanding of the entity so that we can identify the risks of material misstatement. Okay. So, for example, if we get to know in the question that entity or is operating in a highly regulated environment, then a very simple conclusion, being an accountant with this information, with this thing in mind, with this business understanding in mind, that entity is operating in a highly regulated industry. Health and safety regulations are applicable. Lots of compliance and regulations are applicable. Then obviously we can derive the conclusion that there may be a risk for fines or regulatory breaches. Fines or regulatory breaches. There could be regulatory breaches. There could be non-compliances, and those non-compliances could entail penalties. Those non-compliances could even result in license being revoked. Or suppose if it's a cash-based business. So if it's a cash-based business and there are no controls or lack of controls, then we can say, okay, control system is not working properly. There may be a control risk. The fashion or high technology industry, there's the risk of obsolescence of the product. The products may get outdated. And if that's the case, the inventory might need to be lowered down. There may be a risk of obsolescence of the products. So see, the business understanding is eventually helping us in identifying the problems in the financial statements. That's the key here, okay? And being auditors, we are required to know all major aspects of the business, relevant industries, regulators, and external factors, obviously. Nature of the entity, its ownership structure, operation, types of investment, strategies, objective. We might have to understand their internal audit function so that we can see their reports, we can understand what type of controlled environment is operating there. Then there are components of internal control system. So why we are very much concerned about the internal control system? Because if the internal control systems of the entities is strong, if they themselves have a strong mechanism to prevent, detect, and rectify the misstatement problems, then we may reduce our procedures. We may be relieved a bit. Okay, standards allow us that if the results of control testing, if the design, if the implementation of those controls which are in place at the client, if they are working properly, you can reduce the level of testing, the level of transactional testing which you're going to do. Are you getting this? These are 5 internal control components you've already read everywhere: control environment, the directors, the tones, the upper management who is setting the tone from the top. Okay. Entity risk assessment procedures, the processes which the entity themselves have to identify the risks. Information system relevant to financial reporting, whatever the ERP system is, whatever the computerized system is, in which the transactions are flowing, in which the process cycles are being run, because controls are built in the system. You know this, okay? Control activities. So control activities are obviously built in the information reporting system, and then the monitoring, because if the entire control mechanism is not monitored well, it cannot flourish, it cannot sustain. Obviously, in short term there may be compliances, but in long term nobody will bother to comply with those controls. Okay, the auditor must evaluate the design of the controls. So design and implementation both matters. Okay, then what could be the risk assessment procedures? Okay, now see, these are the risk assessment procedures. These are not the audit testing procedures. So basically we are performing these procedures in the very first phase. Okay, so in very first phase, where we are trying to smell the problems out of the financial statements area. So basically, if I make things further easy for you, if I make the discussion easiest for you, then I can say that in the first phase, we are basically cherry picking those areas. We are smelling the risk. And how we are smelling the risk? We are performing risk assessment procedures. And through those risk assessment procedures, we are trying to smell the risk in the areas of the financial statements. And wherever we sniff that there is a higher risk, we pick that area and we channelize more efforts to that area. Okay. So what are those sniffing procedures? What are those catchy procedures so that we can pluck all those areas which are problematic? Okay. So these are called risk assessment procedures. Primarily, risk assessment procedures include inquiries and analytical procedures. Okay. Inquiries, asking questions from the team about the figures, about the changes in the figures of the financial statements, about their business environment, about their operational structure, about their investment structure, comparator cycle, anything. And obviously performing analytical procedures, obviously performing ratio analysis, because we being accountants are very much expert at interpreting numbers, isn't it? So we started at multiple subjects at the basic level. Then when we started FR, when we started performance measurement, then performance management, financial management, advanced performance measurement, SBR, everywhere. We are studying ratios, calculating ratios. Why? Because numbers is such a tool for accountants that if we have the proper numbers in place, if we have proper analysis in front of us, in the numerical analysis, then obviously we can derive lots of conclusions out of it, isn't it? So these analytical procedures, these ratio analysis, these increase decreases, these uh, specific ratios identify the relationships. They identify the trends. Which trends? The consistent one? No. Being auditors, we are concerned with the inconsistent trends. Okay. So comparing actual results with the forecast, how much the forecast has turned wrong, client's position with the industry data, where do they stand in comparison to the industry, financial comparisons, very many ratios. Okay. Then observation of the processes, whatever the entity is carrying out, inspecting. All of this inspection is not the inspection which we are inspecting invoices or inspecting the gate passes. No, this is not that inspection of the transactional documents. No, this is not the inspection of transactional documents. This is the inspection of the manuals. Okay, control manuals, policies and procedure manuals, organizational charts. So this is not the transactional level inspection of the documents. Okay. So this is about the risk assessment procedures. A brief overview about the risk assessment procedures. Now we have the materiality discussion. Obviously, materiality is such an area uh, which every one of us is aware. What is materiality? Obviously, the auditor cannot test all transactions. Auditor have to uh, extract a sample. Why auditor cannot test 100% of transactions? Because auditor is giving a reasonable assurance. Auditor is not giving absolute assurance. Okay. So we need to be about right that financial statements present a true and fair view. We are not giving an absolute opinion on the correctness of the financial statements. No, this is not the thing. Because we being auditors cannot test each and every transaction which has been carried out in the last 365 days of the client. Okay. So which transactions to test? Are we not going to test all transactions? Might be no. Okay. Are we not going to be bothered about the problems in every transaction? Might be no. There might be a very small amount, $1,000, for example, for us. And that $1,000, they might be having some problem. $1,000 balance, $4,000 have been wrongly classified or has been lost. Is this such a big thing that auditor declares this as a fraud, which is significant for the shareholders? Answer is no. Auditor might not even select that transaction in their sampling because their sampling is also based on materiality levels. Okay. So, what is a material amount? The material amount is an amount which is material in the minds of the shareholders, which can affect their decision making. Are you getting this? Okay. As a 320, materiality in planning and performing audit. So, audit standards prescribes few levels of materiality, few benchmarks for materiality. For example, if you talk about revenues, so industry practices, market practices give us this benchmark that for revenues, 0.5 to 1% is the materiality, is the planning materiality. 1 to 2% for total assets and 5 to 10% of profit. Lower limit can also be selected, a higher limit can also be selected. What's the criteria? What is the criteria? Okay. If you pick up the lower limit, you will end up selecting more sample because lesser amount will be material for you. The amount material for you will reduce. So you will be checking all the transactions above that level. For example, I have taken the lower limit. The upper limit was, for example, $10,000 and the lower limit was $5,000. I've taken the lower limit. So now I'll be concerned about all the transactions which are more than $5,000. If I had selected the upper level, then I might be bothered about the transactions which are more than $10,000. So, what are the factors on which the decision depends that which percent within a benchmark are we going to select? Should it be 0.5 or 1? Should it be 1 or 2? Should it be 5 or 10? Okay, now this is a very important discussion, an exam focused discussion. So, every one of you should be very attentive and listening to this. Earlier, whenever the examiner used to give the questions, examiner didn't prescribe benchmarks. Examiner didn't have the practice to prescribe the benchmarks of materiality. So what the students were supposed to do, what the students were expected to do, they were expected to analyze the misstatement in the light of all the benchmarks, all the relevant benchmarks, be it revenue, be it assets, be it profit. Okay. So I hope my screen is still visible to you. Perfect. So when to take the lower benchmark, when to take the higher benchmark? Question number one, the response. Whenever you feel the risk is higher, the risk is higher. And how can you say the risk is higher? For example, the examiner has given you lots of problems in the question which are material. Usually, the exam question will contain lots of problems. It is a safer option to choose the lower benchmark. But suppose the examiner is saying that you have been auditing this client since last many years, and you have been auditing this client since last many. This is not a new client. This is not your new client. And in past, there has not been a good, there has not been a bad record of a lot of misstatements. So you can pick the higher benchmark. But suppose if it's a new client, or suppose the new client plus lots of problems being compounded in that question with the big figures, then we'll say the client is risky and lower benchmark will be selected. Are you getting this? So, but I personally feel that it is safe to select the lower benchmark, even if it is not a new client. Okay. So 0.5 to 1% of revenues, 1 to 2% of total assets, 5 to 10% of profits. And which benchmark to use earlier? That was a question, whether to use profit or assets or revenue benchmark. But now the examiner himself will let you know which benchmark to use. And you have to calculate materiality with respect to that benchmark. Okay. Materiality by nature. Few transactions need not be monetary significance. Few transactions, few numbers might not be required to be of monetary significance. But they are material by nature. Okay. And this is something which is frequently tested. Okay. Sharia. It is not proportionate to inherent risk. It's not inherent risk, inherent risk. It is not proportionate. There may be there may be control lapses for which may be required to reduce the materiality level. As I told you, if suppose if it's a new engagement, if the new engagement, that means it's a detection risk. So when the detection risk increases, even then we are moving to the lower level of materiality so that we can test more transactions to have the confidence on the financial statements. Are you getting this? So materiality by nature, there could be events which might not seem to be monetarily material, but they will be material always. Like suppose if there is a misstatement which might be affecting the regulatory compliance, that's a very important or a very material misstatement. Because if a regulator is furious over you, your license may be revoked. Lots of penalties can be imposed. Misstatement that affect compliance with the debt covenants. Playing with the numbers might be the game is of few percentages or 1% or even 0.5%. But we have done this hanky panky. The misstatement has been done to obtain the loan. No matter that problem might be of $1,000, but that $1,000 has created the mess, has resulted in bank giving the loan to the client because the bank has been shown the wrong report. Misstatements that when adjusted would turn profit into loss. So those misstatements are very particularly important. Suppose if we incorporate that misstatement, the profit changes to loss. And this is the big blow for the entity. Okay. Okay. Materiality by nature. Misstatement when adjusted change the position from current asset to current liability to net assets to net liability position. Obviously, very much worrisome for the shareholders because we have to think from their perspective which amount may be interesting for them, which amount they should know being shareholders. Okay. Which amount is impacting the decision making. So there might not be some monetary amount which may be impacting their decision making, but these items which are material by nature. Okay. When the net asset position is turned into net liability. Related party transactions, including transactions with directors, salaries, benefits, personal use of assets, disclosure as per ICE 24. Okay. Okay, then there is a concept of performance materiality. What does that mean? Suppose we have calculated 1% of $100,000 of revenue. So that means That means if we have taken 10%, sorry, my bad. I'm talking about performance materiality. Performance materiality. What is a performance materiality? Suppose we have taken the benchmark of planning materiality as 1% of total assets. Okay. So maybe the assets are of $100,000. And now, since you have taken 1% as materiality, so you have to see every asset, or you have to make this clear that $1,000 is worthy in the eyes of shareholders. This $1,000 may impact the decision making. Okay. Similar is the case here. These might not be monetarily important events, but these events may impact the decision making of the customers. Any misstatement that turns net asset position into net liability position, related party transaction. Shareholders might be very much interested in knowing the related party transactions, how much chief executive is drawing, how much directors are drawing, how uh, lavishly they're enjoying uh, the money of the shareholders. Okay, so disclosures in the financial statement leading to possible future legal claims or going concern issues. For example, could influence users' decision and may be purely narrative. In this case, a numerical calculation is not relevant. Okay. Okay, so there is some discussion about appropriate benchmark, but we know we are given the benchmark in the exam question, so I'm not wasting any time on this. And then we have the discussion about the business risk and risk of material misstatement, risk of business risk and the risk of material misstatement. So just a 2 minutes break before we move on to the larger break of 15 to 20 minutes. Just 3 minutes, 3 to 5 minutes break. Then we will be continuing with the business risk approach. Okay. So 5 minutes break and then we'll continue. It's not the large one. It's a very short break, a short breather. I can have some water. We'll be back after 4 to 5 minutes. So, dear students, we are back after this very short break. We'll be moving on to the longer one because the prayers time is now approaching. So, after 15 to 20 minutes, we'll be having a longer break. Okay. What is the business risk approach? Now, this is a very examinable topic and very important discussion. And even after lots of information available, even after doing lots of questions, students struggle sometimes to identify the business risk and the financial statement risk. Okay, now what is a business risk? Business risk is, as the name implies, risk attached with the business. This is not a financial statement risk. We have to distinguish, we have to differentiate this from financial statement risk. What is a financial statement risk? As the name suggests, the risk which is attached with the numbers of the financial statements. So this means that business risk has nothing to do with the financial statement numbers or resolutions. Primarily, yes. Then why are we studying business risk? Are we here to give business suggestions? Are we here to improve the business of our client? So why are we identifying business risk in the first place? The answer is until and unless we have proper understanding of the business, until and unless we understand the problems of the business, until and unless we understand the challenges being faced by the business, we cannot identify the problems in the financial statements. Or it's difficult to identify the problems in the financial statements. But yes, if we have the idea of business properly, if we are aware of the business problems, if we are cognizant of the issues surrounding the business, this activity might not be very much linked to the financial statements, but eventually, by thinking like the director, by thinking like a CEO of a company, by thinking like an owner of the company, we may eventually land on the problem lying in the financial statement. And this is called top-down approach, okay? Where we first find business risk and then we link it to the financial statement risk. Business risk, what is the business risk? Any problem with the business, company failing to achieve its business objectives. And what sort of business risks could be? It could be a financial risk, losing money, decrease of cash reserves, compliance risk, non-compliance of any laws, regulations. There could be penalties, there could be problems, there could be fines, there could be bad news in the media, which may destroy my reputation. Okay, if the reputation is gone, if there is some bad news on my company, and if I am suffering reputational problem, is it a business risk? Anyone? If the client is suffering a reputational problem, is this a business risk? I'm asking you, students, please respond me. Is it a business risk? Shariar is saying yes. Only Shariar is saying yes. What others are doing? Respond me. Waiting. Okay. If any event is challenging my reputation, if any event is challenging my reputation, if any business event is challenging my reputation, that is a business risk because that will affect my business. That will affect my business operations, that will affect my customers, that will affect my revenues, There is a business risk. This is a business risk. So anything impacting your business, anything impacting the success of your business, anything impacting or hindering your business, it's a business risk. Could be a financial risk, compliance risk, operational risk. Senior personnel has left, was the showrunner next to CEO. Is an operational risk. This is a business risk. And our next task is to link it with the financial standard, accounting standard, financial reporting standards. If we are able to link it properly, if we are able to link or develop a link between these two, then we can write the financial statement risk, business risks properly. Okay. Risk assessment. So we are assessing the risk. What is the audit risk? Audit risk. What is the risk for the auditor? What is the risk for the auditor? The risk for the auditor is that he performs lots and lots of procedures, but his opinion eventually goes wrong. This is the audit risk. Are you getting this? This is the audit risk. And what are the components of audit risk? What are the determinants of audit risk? Okay, there are three: inherent risk, control risk, and detection risk. These three elements are interacting with each other. If the product of these three, or this is just an explanatory tool that we show it as a product, it's not a numeric product. This is just for understanding purposes. That these three risks are basically cumulatively determining the audit risk. Are you getting this? If inherent risk is high, okay. If inherent risk is high, control risk is high, detection risk is high, audit risk will high. If inherent risk is high, control risk is high, and we need to keep the overall risk lower, can we reduce detection risk? Yes, we can. We should. This is just a conceptual model, just for the sake of understanding. This is not a numerical model, okay? It simply means that these two risks, inherent risk and control risk. Okay. What are these two risks? What are these two risks? And can the auditor have any say or any control over these two risks? These two risks. Inherent and control. Auditor cannot control these two risks. These are outside the control of auditor. Auditor can only control this risk. Auditor can only control this risk, detection risk. Why the auditor cannot control two risks appearing in yellow? Because these two problems, these two problems have already done the damage. Simple. These two problems have already done the damage. Why? Because suppose if we are standing at the end of the year, near the year end, or suppose the year end has passed, then these two risks might have done their damage. Because we are at the end of the year looking at the numbers. Are they okay or not? And if there have been any problem in those numbers, it has already occurred. Now we have to rectify it. We have to identify it and we have to rectify it. We have to identify it, we have to rectify it. We have to identify it, we have to rectify it. Because whatever problem could be there in the numbers have already happened. Operations have been done, the year has passed, whatever wrong entries. Okay, so it's Azan time. It's call for prayers in my background. So I'm keeping myself silent for a minute. Okay. These two risks have already occurred. Okay. Now, what are these two risks? And why I'm saying that these two have already done the damage in the financial statements? Inherent risk. This simply means that whatever account balance is appearing in the financial statements, account balance, class of transactions, assertions, there was some inherent problem attached to it. Inherent problem means by default. In simplistic words, it simply means by default. For example, if I talk about the valuation of financial instruments, what is the default problem attached to it? It's a very, it's a very complex area. Calculation of financial instruments, valuation of financial instruments is a complex area. It includes complex calculations. That those complex calculations may be wrong, may be mistaken, maybe there could be errors in it because it's complex. Another default problem. It is subject to judgment. Judgment can be wrong. Valuation of non-current assets based on the valuation of valuer. Based on judgment, it could be wrong. Impairment based on judgment, it could be wrong. It could be challenged. Revenues, inherent risk that it may be overstated. The management can overstate it. Management can do some hanky panky in the revenue numbers. Inherent risk, by default risks. So those areas which are estimates, judgments, complex calculations have inherent risk. And by default, it's there. We cannot do anything about it. It's there. If they have done any damage, it's already there in the financial statements. You have to now identify it. No other option left but to identify it, because the identification is in your hands. You are the auditor. Control risk. There may be control lapses. There may be weak controls. There may be no controls. And on account of lack of controls, there may be lots of misstatements which have flowed into the financial statements. There is no wall of control standing in front. Here is the financial statements. Here, this way. This is the wall. We're supposed to say this is the wall. This is the wall. And these are the financial statements. These are the financial statements. The books you can see here. These are the misstatements. Misstatements traveling. There is no wall of control. If there is a wall of control, it may prevent this misstatement from entering into these financial statements. But if there is no wall of control, it can simply enter into the financial statements. And whether there was a wall of control or there was not a wall of control, suppose if there was not a wall of control and control risk is high, you cannot do anything about it because the year has passed and whatever damage is done is done. Are you getting this? Is everyone understanding this or not? Please confirm it. So the detection risk, whatever we can do, what is in our hands, in our hands is just to identify whatever problem has been in the financial statements. That's it. If it's there, it's there. Do we have any recourse? Yes. You are the auditor. You have the ability to audit. You have the ability to check the problems. You have the ability to identify the problems. You will do audit testing. You will do sampling, audit testing, and you can identify the problems if there are any. How can we reduce the audit risk? Increase the testing, increase the testing, increase the testing, test every transaction. No, that's not possible. We cannot test all the transactions, hundreds of thousands of transactions within a month or so. We cannot. This is the detection risk because you cannot check everything. So, if you check all the transactions, the audit will be inefficient. You will need a lot of time, you will need a lot of effort, a lot of resources, a lot of cost involved. So we'll try to strike we will try to strike the optimum balance. Are you getting this? Is this crystal clear to everyone? Great. The three types of risks which are examinable: risk of material misstatement. Okay, when the question only says the risk of material misstatement, see this. When the question only says the risk of material misstatement, it means you are only asked about these two. Are you getting this? Without it, ignore the detection risk. If you are asked about risk of material misstatement only, then you're only asked about these two. You're not asked about detection risk. And usually there are not much detection risks to identify and write in the examination. Only in one case, or one or two cases, you can identify the detection risk. We will see when we will practice. When there is a new audit client, then there is a detection risk in opening balances. That since we have not audited those opening balances, there could be problems in those opening balances, misstatements in those opening balances. Therefore, we make a bullet point: detection risk in opening balances, or risk in opening balances, and we write a point. Are you getting this? Otherwise, usually there are not much points for detection risk. Same goes with the control risk. Because in exam question, you will not find many control risks. Yes, they could be one. Usually, if there are maximum, most of the cases, you will see one control risk, maximum two, more than that. Okay, so this is again an area, control risk, which is not a very frequently asked, or these are such easy risks which you have already done, or these have been tested in the previous exams. So examiner is not really interested in control detection risks much. I'm not saying it doesn't come up. Yes, it comes up, but one risk, suppose one for control, one for detection risk, and six inherent risks you have to write. For example, it could be five, six. So the three types of risks are okay. Audit risk, the risks financial statements, the materially misstatement, plus audit tests fail to spot this. I have already summarized this. So risk of material misstatement is inherent risk plus control risk, and detection risk stays a part of it, apart from it, because it's not part of risk of material misstatement. Business risk, because these two, why these two are called risks of material misstatement? Because these two have damaged the financial statements, have misstated the financial statements. These are the risks which are misstating the financial statements. These are risks of misstatement. Okay. So what is a business risk? Anything in the scenario that could damage the company, anything that could go against the company, anything that could be detrimental to the interest of the company. That's a business risk. And how can we link the business risk with the financial statement risk? Okay, so here, this is the slide where I'll be taking the prayers break. I'll be back after my prayers. So if any one of you who wish to offer your prayers, want to have your dinner, cup of coffee or tea, please do have it. We'll be back after 15 minutes or so, 15 to 20 minutes. This break will be a 15 to 20 minutes. The major break, the bigger break. So then have some chill, and we'll be back after 15 to 20 minutes. Okay. And we'll continue our discussion. Dear students, can you please confirm me? Am I clearly audible and visible to all of you? Great. So welcome back, and we'll resume our discussion. Uh, we discussed about our business risks, and now we will see that how can we link these business risks with the financial statements risk? How can we link these business risks with the risks of material misstatement? Are you getting this? So business risk usually cause risk of material misstatements. Are you getting this? Usually business risks cause risk of material misstatement in the financial statements. For example, extreme business risk, any, extreme business risk of reputation, extreme reputational risk may lead to the closure of business. Risk of non-compliance, extreme non-compliance may result in revocation of license, loss of operations, shutdown of operations. Any business risk which is heightened may lead to the closure of business. Extreme business risk which is threatening the going concern. Now, risk of going concern itself is a business risk. It has nothing to do with the financial statements. Whenever the word going concern appears, the students start thinking about financial statements. This is phenomena that the business cannot continue its business in the foreseeable future. What will be its implication on the financial statements? IAS 1 comes in and says, okay, going concern is in threat. You have to give the disclosure. What if you do not give the disclosure? That's the risk of under disclosure. The risk that in this situation, the disclosure might be missing. Getting? Disclosure might be missing. We're not talking about the breakup basis yet. There is a threat of going concern. We'll discuss about the GC in detail. Don't worry. Court case. There is a court case going on. Now, the court case going on, is it a financial statement risk? No. If the court case goes wrong, it will lead to penalties, outflow of funds. That's a business risk. If the court gives the verdict against us, it might be a reputational risk for us. Customers may be lost. Revenues may be lost. Is it a financial statement risk? Is it a financial statement risk? The businessman will say, no, it's a risk to my business. Okay, it's a risk to your business. But with what impact will it have on financial statements? IAS 37 implications. Provision, contingent liability, disclosures needed. This business risk will lead to financial statements. Penalties, book the provision. Book the provision. Are you getting this? Fall in demand for a product. Technology has changed. Your product is obsolete. Your product is outdated. Your machine is outdated. Fall in demand of the products. IS2 inventory. Inventory should be measured at lower of cost or NRV. The product is obsolete. The product is obsolete. Sorry. My product is obsolete. That's my business risk because I will not be able to sell my products. I will not be able to recover the amount. That's a business risk. But what that business risk is indicating, that business risk is indicating that my product may be carried at a higher value. So I will promptly think about the IS2 implication, lower it down to the cost or NRV. So the event being triggered in the business domain, it alarms me of something fishy in the financial statements domain. Are you getting this? Inventory may be obsolete. Technology may be obsolete. Now, the technology is old one. Now, my machine, which is producing this inventory of old fashion, old technology, this machine may be impaired. Bring it down, lower of two. Carrying value, recoverable amount. Recoverable amount. What is recoverable amount? Higher off. Higher off. Value in use, fair value is cost to sell. Okay. So what is the exam technique? Now here comes the exam technique. So what is the exam technique of business risk? The exam technique of business risk is you have to explain the business risk, not from financial statement perspective. This is the biggest problem with the students. Students start linking it with the financial statements when they're explaining the business risk. No, you shouldn't. You should explain the business risks as if they are the risks to the directors, as the directors of the business will care about. The focus here should be on adverse impact to profits, revenues, cash flows. Okay, just hold on for a second. Apologies for the disruption. Okay. Business risk, the risk the directors will care about. You have to think the mindset of the business owner. You have to wear the hat of CEO. You have to wear the hat of the business runner. You have to remove the glasses of an auditor. You have to remove the glasses of an accountant. And you have to see from the eyes of the business owner what risk my business is facing. Are you getting this? The focus here should be on the adverse impact to the profits, revenues, cash flows. Now, profit, revenue, and cash flow, although in our discussion, these three are financial statements measures. But don't you think that these are the business measures in the first place, and then they are the financial statement measures? In the first place, these are the business measures, profitability. Even anyone who is running the smallest of a shop will think of its profits. Even the one who has zero financial knowledge, zero accounting knowledge, zero auditing knowledge, will be talking about profits. We'll be talking about sales. We'll be talking about cash flow problems. So these are not specified or tied up with only with the financial statements. Any layman, any businessman will talk about these three measures, whether even he knows what is the financial statements or not. You will even find those businessmen, when you talk financial statement, they might not be aware of the terminology of the financial statement. But when you talk about profits, you talk about sales, revenues, you talk about cash flows, they'll start discussing their business issues and problems. So whenever you are explaining a business risk, you have to explain it with these three parameters, keeping in with these three parameters. If there is something going wrong with the business, if there is something going wrong with the business, these three might be impacted. Either my profit will be impacted, either my sales revenues will be impacted, either my cash flow, cash drain, cash outflow will be there. At the moment, I'm not talking about the misstatement in the financial statements when I'm explaining the business risk. Are you getting this? Exam technique. What is the exam technique? Identify the information from the scenario which is creating the problem, which is creating the risk. Explain what impact will it have on the business operations. As I told you, you have to wear the hat of the businessman, not the hat of the auditor. We will, we will attempt the questions, we will solve the questions, and I'll show you how you're going to do this. Link it with the relevant trends if numbers are given. If the numbers are given, and in some questions the numbers are given, yes, they give the financial statement figures. Link it with those numbers. Okay. And above 1 and 2 will help you in identifying the related financial impact. Now that's the next phase. That's the next stage. These above two things, the business risk, will eventually help you to find out the financial statement risk. Marking scheme is usually a well drafted business risk. A well drafted business risk will fetch you 2 marks. Okay. So up to 1 mark for identification, but I've kept it a half here. Up to 1 mark for identification, properly explaining identifying the business risk. But I've written half mark for identification and 1.5 mark for better explanation. The better you explain, the higher chances that you're getting 2 out of 2 in business risk. But if your explanation is lacking, if you are missing any parameter of a business risk in your explanation, then you might end up scoring 1.5 or 1 mark in business risk. Okay. An additional half a mark is also available usually for relevant trends for business risk evaluation. If the numbers are given, if the ratios are given, you might be required to evaluate in relation to those numbers. Okay. And here comes the important discussion of the professional skills marks, because there is one very important professional skill, that's business acumen, professional acumen, business acumen. Okay. So that business acumen will be tested here in business risk. Commercial acumen, sorry, commercial acumen. It will be tested here in case of business risk. Okay. When you are thinking of business risk, you are thinking of a business problem, writing a business problem, that will show your commercial sense, commercial acumen. And wherever I'm saying that there is an additional half a mark available for relevant trend calculation, analysis, and evaluation, you are linking the numbers with the scenario, you're linking the numbers with the story given in the question. And then by using those numbers, you are better evaluating the story, you are better evaluating the situation in your answers. Are you getting this thing? Now let's see a few examples of well planned and well drafted business risks. For example, in a question, you find this information: a major customer is struggling to pay their debt. This is the information in the question. No, now see how simple it is that you should be able to identify this information as a business risk. If a major customer is struggling to pay their debt, that's a business problem. Business will suffer. Business will suffer due to this problem. This is identification of the problem. How will the business suffer? How will the business suffer? That is the explanation. Implications. If the customer cannot pay the balance, the company will not receive the cash, which will reduce cash inflows. So I told you, cash is a business indicator. Business indicator. Think from that perspective. Cash inflow will be disturbed. Problem number 1. The debt will need to be written off, which will reduce profit. Profit is a business measure. So if debt is no more recoverable, is an expense, which will reduce my net earnings. Number 3, impact. Future revenues will also decrease as the major customer will no longer be trading with the client. Since this customer is struggling to pay their debt, might be bankrupted. Obviously, the future sales is lost. Three implications. So you have to try to link it with the cash, profits, decrease in revenues, or even closure of operations. This is a business risk. Are you getting it? Foreign currency transactions. See this one as well. You will find this information in the question. The first bullet will be the information which will be given to you in the question. The company purchases all goods from an overseas supplier. This information. This information. I don't know why this highlighter makes some spikes, interesting spikes. Okay. The company purchases all goods from an overseas supplier. This is the information given in the question. Now, this interesting information is basically your scoring opportunity. This interesting information, this simple information in the question is your scoring opportunity. Those students who find it as a scoring opportunity will make a business risk out of this. If the company is purchasing all goods from an overseas suppliers, that will result in foreign currency transactions. And if the company does not use any hedging instruments, it will be exposed to exchange rate fluctuations. Now, is the exchange rate fluctuation, is it financial statement problem? Answer is no. Even a person who is not familiar with the financial statements, you will see any businessman crying on account of adverse exchange rate fluctuation because it affects their cash flow, it affects the prices, it has to do with the financials, but at the step two, but that's a business phenomenon, a business risk, and it will affect the price of purchases. Are you getting this? And if exchange rate moves in adverse direction, the cost of purchases will be higher, resulting in reduction in profit. This is also linked with the profits. Are you getting this? This is a sample. Yes, delay in delivery, Sharia. Change in taxes, increase in taxes is a business risk. Delay in delivery, yes, it's a business risk. Okay. If I delay something, there might be penalties, contractual penalties from the customer. Okay. The delay might impair my reputation. My customer may think that Mr. Munir always delays the good. They're not trustable vendor anymore. Should switch the vendor. Reputation risk isn't. Okay. So you have to think of it and you will start finding the risks. Okay, so this is just an indication for December 2018 question, a demo of one of the business risk, health and safety regulations. The examiner gives in the question that this is a highly regulated industry. Now, when the examiner says this is a highly regulated industry, lots, lots of health and safety regulations to comply. This is also given in the question. So if these sort of information is given in the question, it simply means that the examiner is spoon feeding you the business risk of non-compliance. That what if these health and safety regulations are not complied? What if you violate these health and safety regulations? There's the risk of non-compliance of laws and regulations. Are you getting this? Okay, we got it. This is a risk of non-compliance. But what this failure will result in, what this failure can do, what this failure can do, what this failure can do, what this failure can do. Worse implications. fines and penalties, drain on companies' resources, affecting profitability, affecting cash flow, adverse publicity, loss of customers, affecting revenues, revocation of license, going concern issue, business may be shut down. Simple. You have to be very specific, on target. Beating around the bush, writing long paras, useless paras will not do the trick. Keep it simple, keep it straightforward, but keep it accurate. You'll get the marks. Weak governance structure. Okay, this is another example, but we will attempt the questions. So one example is enough. Let's move on. Because time is not that much. Okay. High annual capital expenditure and maintenance expenditure. Company is excessively expending on these equipments. What happens? The company's success relies on gyms being equipped with modern equipment and other facilities such as tennis courts. This requires high annual capex, lots of investment, which will result in the cash flow problems, which will result in the drain of cash. Okay. See here, percentage has been used to explain business risk. See, this is how you can get professional marks for analysis and evaluation. By calculating the relevant percentages and by linking it with the scenarios. This requires a high annual capex. For example, this year alone, $5.5 million have been incurred on maintenance expenditures, which are more than 4% as compared to last year. Such high capex is a big drain on cash and profits, and the company could face liquidity problems. Getting this? Analytical procedures. Analytical procedures, very important. Analytical procedure as risk assessment procedures, as risk assessment procedures, as risk assessment procedure. Okay. Since we are very much keen in identifying the risks, we are very much interested in identifying the risks. So one method is that examiner tells a nice story. There may be a problem. There is a story. And we can link that story to any non-compliance of IFRS. But even the numbers can tell you the story. Even the relationship between the numbers can tell you the story. An analytical procedure is a famous tool, is a famous risk assessment procedure, which will help you out in smelling or sniffing the risk, that which area is smelling bad. And it is compulsory at planning stage. Increased focus as 315 revised in 2019. It is an efficient way of identifying financial statement risks. You will be required to calculate various ratios if the numbers are given. Looking at the data, if questionnaires financial statement extracts in the scenario, use the figures to identify the risks of material misstatement. Look at the story, look at the movement of figures from the last year to this year. If movement does not tell you with what story says, the risk that the figures is wrong. The question is telling you another story. Did we have achieved economies of the scale? The director is telling you that they've achieved economies of the scale. They've reduced the cost of their products. The financial statement is saying that cost of products, the gross margin has reduced as compared to previous year. So don't you think there is a contradiction with what story says and with what you have calculated through your analytical procedures? Calculation is useless without interpretation. Very important point. Very, very important. Calculation is useless without interpretation. Because here you will find the professional marks for analysis and evaluation. You have to use those ratios and numbers to explain. What could be the common ratios? Calculate ratios, aim for 6 to 8 maximum if the numbers are given. GP margin, gross profit margin, operating profit margin, interest cover, receivable days, payable days, inventory days, current ratio, quick ratio, return on capital employed. It's not ROCS, it's ROCE, gearing ratio. In your exams, you may be asked for possible analytical procedures and its analysis with the non-financial data as well. What's the non-financial data? Number of employees. Getting number of machines breakdown during the year. Link it with the repair expenses. Link this number of employees with this increasing salary expense. So these non-financial parameters will also help you out a lot in analyzing the numbers. Okay. What is the technique for risk of material misstatement? What is the technique? There is a very strong technique, a very interesting technique, 6-step technique. If the numbers are provided, calculate materiality. Number one thing. Once you're done with the materiality, if it's material, that means the risk is significant. An examiner particularly says, prioritize the risk in order of significance. So those whose magnitude is high, those whose magnitude is high, and the likelihood is also high, then they are in the higher spectrum of inherent risk. And those risks, magnitude is low or the probability is low, they're at the lower end of spectrum of inherent risk. Getting this? So then, first of all, you calculate the materiality of the problematic area. For example, inventories. You calculate the materiality of misstatement. Okay, that's material. Suppose if it's material, then you have to identify which financial statement area is under the risk. Is it in inventory? Is it intangible, which is susceptible to risk? Which financial statement area? And which risk type? Usually it will be inherent risk. It could be control risk, it could be detection risk, but usually 90% of the time you will be encountering inherent risk. There's an inherent risk of misstatement in inventory. And what risk? Risk of understatement, overstatement, overvaluation, undervaluation, wrong. What risk? Valuation risk. Okay. If you're saying that's the risk, what's the right treatment? What should we do? Accounting treatment, proper accounting treatment should be followed. And what's that? Inventory should be carried at lower of cost. And now we mention that treatment. So I cannot recall the standard number. Don't worry. Simply say, as per the relevant accounting standard, inventory is measured at lower of cost or NRP. Then you also have to explain why you feel there's a risk of material misstatement. Because the scenario suggested. Because the CFO is saying that our inventory will be sold at higher prices. Although the sale has decreased, although the product is obsolete with the manager, but the CFO is saying that we will be able to sell these products at the regular prices. See, this bogus statement is made us believe that you will not follow the proper criteria. Why you feel there is a risk or why you feel that above accounting treatment might not be followed. So basically, you are applying the scenario on this requirement. You may be required to use analytical procedures to identify the relevant trends if the numbers are given. Increase, decreases compared to previous year. This is the basic increase, decrease, promptly calculated. This will help you out a lot. If other numbers are also given, GP margin, OP margin, interest cover, whatnot. And don't forget to write the impact. What impact this risk will have? Will it be overstating the revenues or profits, understating, under disclosure, whatever the case is? 1 mark for relevant materiality calculation subject to capping. 1 mark for identifying risk and impact. Risk impact. 1 mark for relevant accounting treatment applied to the scenario. Additional half a mark for relevant trend calculation and professional marks, obviously hidden here. But this is the latest marking scheme which is on your screens. First of all, you will be calculating materiality, and the benchmark is prescribed by the examiner. So don't try to get over smart. Follow the benchmark which is told by the examiner in the question. So 1 mark. So the latest marking scheme says that there may be 3 marks. There are 3 marks for materiality. So, as per my understanding, the 1 mark will be for the justification of materiality para. As per the benchmark the examiner prescribed, you will write a para based on the materiality, justification of materiality, and 2 marks for calculations in various risks. 0.5, 0.5, since now the benchmark is prescribed. So, according to me, if you can write 4 materiality, identify 4 materiality, you'll get 0.5 for each. And if you are able to identify risk, impact, accounting treatment, and accounting application, I told you 0.5, 0.5, 0.5, 0.5 marks for everything. 1 mark for identifying risk and impact. That means 0.5 for identifying and 0.5 for impact. 1 mark for relevant accounting treatment applied to the scenario. So 0.5 mark for the treatment and 0.5 mark for application. So I have broken down this for your convenience. Okay. So suppose if you are drafting a juicy risk in which you find the risk, in which you find the impact, in which you found the accounting requirement, and you have also applied it properly, this means you're going to get 2 marks for that risk. 0.5, 0.5, 0.5, 0.5. Sometimes the accounting requirement is a big one. It requires detail. There are multiple aspects in one single risk. Then that risk will be a juicy one. That will fetch you the maximum possible marks. For example, if in a scenario you are able to identify materiality calculation, so you get 0.5. You identified risk, impact, accounting requirement, application, so you'll get 2 marks for that risk. Getting this? Doing all elements right will fetch you the relevant marks in your kitty. Then relevant trend calculation, because numbers are given. So the examiner expects you that you are such a professional guy that you will link the trends. If you can, you can get 3 extra marks maximum. Few examples of well planned and well drafted audit risks. Same event which we discussed earlier with the business risk, same event, same situation, same circumstances. Can that business risk which we drafted with the receivables, can that risk help us out in drafting the financial statement risk? Answer is yes. See how. A major customer is struggling to pay their debt, and as a result, the receivable balance is significantly higher than last year. The balance outstanding materiality. See, the balance outstanding represents 5% of the total assets. Therefore, it is material to the financial statements. Okay? Material to the financial statements. And in accordance with IFRS 9, now here comes the accounting treatment. In accordance with IFRS 9, a receivable should be measured at transaction price less allowance for ECL. And there is a risk that the receivables and profits are overstated if the debt is not written off. Are you getting this? Foreign currency transaction. Earlier, when we were explaining foreign currency from business risk perspective, we were adopting different approach for explanation. But here we are taking it as audit risk. From where it has derived? From the business risk. We have derived the financial statement risk. From business risk, we have derived this financial statement risk. Let's see how are we drafting it. The company purchased all goods from an overseas supplier, resulting in foreign currency transaction. Same piece of information which we used to draft a business risk. But here, our direction will change. We will not talk about the business impacts. We will talk about the financial statements implication. In accordance with ICE 21, effects of changes in foreign exchange rates and currency, purchase should be translated using spot rate. Purchases should be translated using spot rate. Whenever you purchase anything, that rate you will be recognizing that date's rate, you will be recognizing the transactions. Okay. Any payable balance outstanding must be revalued using year-end date. That will be revalued every year. There is a risk that purchases are misstated if the exchange rate used is incorrect, because we will need to use the spot rate of the date of purchase or average rate. But a purchase will be misstated if the exchange rate used is incorrect. Now, all these things, exchange rate, closing balance, spot rate, the owner, the businessman will be least concerned. He'll say, do whatever you want to. But I have faced the loss on account of this currency fluctuation. I don't know the financial jargons, I don't know the accounting jargons, but the thing which I know is that due to the currency depletion, I have suffered higher costs. Are you getting this? That is the business risk. But how will it be? How will it be disclosed in the financial statements? How will it be incorporated in the financial statements using spot rate for the P&L transaction, transactional event, and if any closing balance on closing rates. Okay, so you can read the others on your own. I've already told you if the controls are strong, properly designed, we may rely on the controls. Otherwise, we'll have to do substantive testing. So, what is substantive testing? It assumes that controls do not work properly. Even if controls are working properly, then even we are supposed to perform substantive tests. Are you getting this? But substantive approach. Desktop control systems are not that strong. There are anomalies going on. Then we will be adopting substantive approach. Substantive approach means within substantive, there are two areas: substantive analytical and test of details. So we will try to move on towards test of details. When can you say the risk is significant? When there is risk of fraud, risk on account of adverse economic situation, complexity of late party transaction. All these makes the risk a significant one. Qualitatively significant. Qualitatively, no matter the amount involved might be lower, but qualitatively, this will be a significant risk. If the auditor determines that significant risk exists, they must obtain the necessary understanding and how entity controls that risk. What can you do? You have smelled the risk. And out of 10 areas, you have sniffed the risk of misstatement in 4 areas. What are you going to do? You are going to design the responses. What next? What next? If you have found that there are 4 risky areas, then extra efforts will need to be channelized towards those areas. You will need to emphasize the need for professional skepticism for the teams. You might have to assign more experienced staff. You might have to do more supervision. You might have to incorporate additional element on predictability. If you are carrying out cash count 31st of December every year, do this 2-3 days before this time. Client might not be ready and they might be on the verge of committing errors. And you may find it out. Getting? And what could be the responses? If we found a risk, if we sniffed a risk, we will extend our procedures, extend skillful, will depute a skillful guy, we will place less reliance on control, perform more testing, more transactional testing, changing the time and frequency, blah, blah. Professional skepticism, we know this is the trait of critical thinking, questioning mind. We shouldn't accept things on the face of it. This is somebody of professional skepticism. Okay. Should go through. Now, this is the short form. The next step is performing audit procedures, gathering audit evidences, performing audit procedures, gathering audit evidences. What audit procedures to test? Matters to consider and evidence that should be on file. So questions come up usually. Matters to be considered and evidence should be what evidence should be on the working paper file. So the questions are targeted on these two areas. So whatever the matters to be considered are, matters to be considered. It's very similar approach as we have just saw. Are you getting this? What are the procedures to test? What matters to be considered and evidence should be on audit working paper file. Again, it will require thinking. Rest of the pattern, same as the audit risk. Matters to consider. I'll tell you. And what evidence should be on audit working paper file? Okay. Now, is there any difference between the audit and the audit procedure? Is there any difference between audit evidence and audit procedure? My question. Can anyone tell me? Is there any difference between audit evidence and audit procedure? Anyone? I hope you can see my screen, isn't it? Everyone? Yes. Is there any difference between the audit procedure and audit evidence? Answer is yes, but not a big one. For example, this is an audit procedure. Inspect sales agreement to verify. So hold on. Okay. So procedure, inspect sales agreement to verify date, amount of proceeds, name of buyer, and other relevant terms and conditions. So you're performing a procedure, you're inspecting a document, you're performing a procedure, starting with the verb. Inspecting a sales agreement to verify date, amount, terms and conditions, and other relevant details. What is an evidence? If examiner asks, what evidence will you find in the audit working paper file? You will say, I expect a copy of sales agreement which will verify the date, proceeds, name of the buyer, and other details, etc. So that means in both of these two things, objective will remain the same. But one might start with the verb, the other might start with the object, whatever document you are having a look at. So there is no fundamental difference between these two. Not a big difference, in fact, between these two. If you can hold on the approach of one, you can identify the other. What say? Isn't it? If you can identify, if you can write the procedure, automatically you are done with the evidence. If you can write evidence, you can write the procedure. And the question comes up in the examination, matters to consider and what evidence should be on audit working paper file. So what evidence should be on audit working paper file? Copy of sales agreement, extract of BOD minutes. Simple. A document evidencing the physical verification of the fixed assets. So that will be a document outlining some figures or procedures, whatever it is. Okay. Okay. So, dear students, these are the discussions which are simple, straightforward discussion. What are assertions? Now, this slide is important. Whenever you are drafting a procedure, remember ASP, action, source, and purpose. Students lack in drafting a procedure. They are unable to draft a procedure properly. I'll discuss on this. Okay. But remember these three things. You have to identify action, source, and purpose. Other things are relatively simple, straightforward. So I'm skipping it. You can go through on your own. The question comes matters and evidence question. Matters to identify and evidence you will finding on audit working paper file. So you basically have to recall the evidences. So there are two checklists. There are two checklists. One will recall the procedures in your mind, the other will recall the evidences in your mind. But if the evidence is recalled, obviously you can reach to procedure. And if an audit procedural list can be recalled, that list will help you out in identifying the evidence. So both these lists are supporting each other. Okay. So audit procedures, analytical procedures, ratio analysis, comparison, inquiry, confirmation, inquiry from the management, confirmation, inquiries from the outside parties, legal confirmation, tax confirmation, debtor confirmation, table confirmation. There's also sort of inquiry, but not from in-house people, outsiders. Inspection of documents, invoices, checks, bank statements, amount tracing, observing a process like reconciliation, recalculation. If you are given the fixed asset register, recalculate the fixed assets. If you're given the salary breakup, allowances, PF contribution, recalculate it. Simple. Are you getting this? Audit evidences. So AEIOU, an audit evidence checklist or mnemonic is SAD 3 as for subsequent events, because subsequent events may also give you the evidence. For example, subsequent sale price of an item will give you the evidence of the price which might exist as at year end. Are you getting this? So this is again sort of audit evidence. So, A for accounting records and assets inspection. A for accounting tracing the opening balances, accounting records, ledgers. Are you getting this? Assets inspection. You can go and you can see the asset physically. Directors representation is an audit evidence. BOD minutes extracts audit evidence. Any document, be it invoice, be it purchase order, gate pass, bank statement, any document which is supporting the numbers. Getting this? Third party confirmation. Three, SAD three. So A2, there are two A's, accounting records and asset inspection. D, there are two D's, directors and documents. In directors, there are two directors representation and BOD minutes as well. See, third party confirmation. So I hope it's clear till now. Now see what's the question type. Matters and evidence question. Matters and evidence question. What matters will you expect and what evidence will you expect in the file? You have to test every fact in the scenario. Recall two checklists, as I just told you. And there are a few examples of audit procedures. So I'm not again going through these examples and of examples of procedures. I'll simply recall few for your reference. Like a student might simply write investment properties, inspect the title deeds, and that's it. No, that's incomplete. You are inspecting the verb action, title deeds. Why you are inspecting? To confirm the ownership of the investment property. Students miss this from scratch. Students, you tend to miss the reason from scratch. Why are you doing this? Discuss with management to confirm their intention. That's not enough. Which intention? To hold the property. For what? For investment purposes rather than for use. Be very specific. What are you inquiring and why are you inquiring? Perform a physical inspection of the building. Why are you doing so? To confirm its general condition and that it is not occupied by the client, so that it can be classified as an investment property. So the procedure should be very explanatory. Action, source, and purpose. All three things should be there. So obviously, you can read these procedures at your home as a homework. Okay. So you can go through these on your own. Okay. As far as the group audits is concerned, I'm not discussing it now because I'm not feeling well. I'm feeling very tired at the moment, unfortunately. So I'll keep the session till here today, and we'll try to cover up things tomorrow along with the practice as much as we can, preferably the near one attempts. Okay, June 23, December 22, March 22. So we'll be doing practice as well, but we'll continue our discussion tomorrow. And few of the topics we will discuss as and when the question arrives. So don't worry about that. But I'll take your leave for today because there have been some hectic schedule today, so I'm feeling quite tired. So I'm not. I might not be able to continue it properly. So let's discuss this tomorrow, and let's start practicing from tomorrow. Okay. So in the upcoming sessions, we'll be picking up a lot of questions from past exam papers, and we will apply the exam technique so that you get to know what's the process of application of exam technique. Okay. So thank you so very much. Take care a lot. May Almighty bless you all. See you tomorrow uh, around 6:30 or 7. If I can, if I might be able to, I might be required to push the timing 30 minutes more forward. So it might be not 6, might not be 6:30, it might be 7. So I've already communicated you in advance. So see you tomorrow. Take care a lot. Bye bye. Most welcome.